Welcome to another episode of the Doctors Building Wealth podcast. Today, Kenji and I wanted to cover 3 ways doctors can lower or eliminate their income taxes with real estate. Now, this is an exciting topic, and we've covered it in different places in pieces before, but I don't think we've actually just sat down and really covered all of these 3 strategies in detail. And so we wanted to make the time to be able to do that today on the podcast. So the subjects that we're going to be covering are real estate professional status, leveraging the short-term rental tax loophole, and another tax loophole, which a lot of people in our community have been using, called the medical practice tax loophole, or at least that's what we're calling it. So these are 3 ways that you can actually shelter 1099, W-2 income, and actually medical practice income with the third one. And so we're going to talk in detail about each one and what it entails. But keep in mind that we are not CPAs. Kenji and I have used real estate professional tax loophole. We've used the short-term rental tax loophole. We've never used the medical practice tax loophole, but we've had a number of students doing that. But we're not CPAs, so you really need to talk to your CPA when you're making tax decisions, because they really understand your exact situation and they're going to be able to best advise you.
Well, while we may not be CPAs, we have a lot of experience claiming, especially real estate professional status. We have experience with the short-term rental tax loophole, but real estate professional status, I've been a real estate professional for the last 10 years. And so we've used this to shelter all of our income for 7 years in a row until we moved to Puerto Rico. So again, I don't know too many people who have done that for 10 years in a row. And so this episode really is coming from our personal experience leveraging these tax loopholes.
Okay, so the first one we're going to cover is real estate professional status. It's also called REPS. And I have to say, before we even start this, that there was recently an article that people were kind of posting around from one of the other physician blogger spaces. And they were talking about how, no one really can claim real estate professional when you are out of state investor. And that's really not the case. And so we're going to be talking about that too, because I think it's such a relevant thing that has been happening, a lot of conversations that have been happening more recently. So what is real estate professional status? Well, basically, the key is it allows you to take losses in real estate. And a lot of these are called paper losses or phantom losses. So it's not that you're losing money in real estate. A lot of people get confused when they hear losses. They think that they're losing money, but that's not the case. In fact, you can use something called depreciation in real estate to create losses on your taxes, but just continue to cash flow and make money, even though it looks like you're losing money on taxes.
And this is really unique to real estate. You could run a business and have a loss, and that loss will shelter your income, but you're not going to be doing a good job if you're running your business at a loss. Whereas real estate is really unique in that because of depreciation, you can actually still cash flow. In other words, put money in your pocket and show a loss on your tax return. And again, that's what really makes real estate a very, very unique business that allows you to make money and also show a loss on your tax returns.
So what's depreciation? Well, the idea is that the government allows you to write off a certain portion of the value of the building that you own as a loss every single year on your taxes. Now, there's something called straight line depreciation, where you write off the same amount every single year that you own the building, and you depreciate a building over 27 and a half years if it's a residential building, or if it's a commercial building, like it's your medical office building, you depreciate it with straight line depreciation over 39 years. Now, there's something called bonus depreciation or accelerated depreciation. Those both allow you to kind of shift a lot of the depreciation losses that you would be writing off, in the next 20 to 30 years, shift them towards the first year of ownership of that property. So what that means is that you actually are able to shift a lot of depreciation towards when you first are owning the property. And that's why all of these work so well, is you can buy a property in that very first year, you're going to generate a lot of losses on your taxes. And so if you're getting a lot of income from your medical office, or you have, a lot of W-2 income or 1099 income, or even business income, you're able to shelter that. And I should mention business income, because one of the things that we were able to do is when we first started this whole process and we had real estate professional, we sheltered our W-2 income as physicians. But later on, when we had semi-retired MD and it was bringing in income, we were actually able to shelter semi-retired MD's income using depreciation from our real estate portfolio.
Now, the question is, how do you shelter that income using those losses? And that's where real estate professional status comes in. So real estate professional status is a tax status. The IRS has very clear criteria. And when we talk to CPAs, they say the criteria are very clear. It's a bright line, meaning that there's no ambiguity about it. If you meet the hours criteria, then you meet real estate professional status. And what are those hours criteria? Well, the first one is often referred to as the 750-hour rule. And so you have to do a minimum of 750 hours in real estate. That's the first criteria. The second one is you need to do more hours in real estate than any other profession or job. And again, that is also hours based. And when you look at both of these in combination, well, if you work 1,000 hours as a doctor, then you need to do more than 1,000 hours. That's the second test, right? Where you do more hours in real estate than any other job. And you also in that situation do more than 750 hours. See, 750 hours is just a minimum. That's if you don't have any other job. Let's say you're a stay-at-home parent, then you don't have another job, then another profession, then the 750 hours is the minimum. And if you meet that, then you meet the criteria for real estate professional status.
So what we often see is there'll be a physician maybe working full time and has a stay-at-home spouse, or has a spouse that doesn't like their job and wants to cut back. And maybe they even want to just cut back to half time, but they want to do real estate and they're going to be able to make it their primary occupation where they're doing over 50% of their time in real estate investing. And then they're also are going to buy a big enough real estate portfolio to be able to do 750 hours plus. Now, keep in mind, I just said big enough portfolio because a lot of times we'll get people saying, hey, if I just buy one property this year, can I claim real estate professional? And like Kenji just mentioned, it's a bright line test. It really is based on the hours. And we have seen people in our community that with just a couple properties do have enough hours that they can claim real estate professional status. But one of the things you really have to ask yourself is it worth it? So if you only have a couple properties and they're inexpensive and you're claiming real estate professional status, and it means you have to do at least 750 hours, 500 of which need to be on your portfolio if you're grouping your portfolio properties together, which is what a lot of people do in our community, then that's a lot of time. And if you're using depreciation and you're writing off, let's say, $100,000 and it's going to save you $30,000 in taxes, is it really worth it? Is it worth your time to do over 750 hours just to save $30,000 in taxes? I don't know. That's a question you have to ask for yourself. But when it really works well, when real estate professional works the best is when you buy a number of properties and you create substantial losses. And those losses ideally shelter all of your income from taxes. Or if you don't use all of those losses that year, that they carry forward and shelter future years' income from taxes. That's when it's really going to make a difference in your finances, just to be able to get that IRS check back at the end of the year and be able to take that and reinvest it in your next property is huge. And it helps your growth be so much faster.
Now, I mentioned the 750-hour rule, and then also there's that 50% test. And there's actually a third criteria called material participation. And this is also an hours-based test. There's 7 different options. You only have to meet one of the 7 material participation tests. The one that many of us doctors use is called the 500-hour rule. And that one is, as Leti mentioned, if you have a number of properties, you group them all together. It's working 500 hours across that whole portfolio. And if you do more than 500 hours, then you meet that test for material participation. So again, real estate professional status really encompasses 3 criteria. The first one's that 750-hour rule. The second one's that 50% test. And then you also have to be materially participating in your portfolio. And in your portfolio is key. It has to be your portfolio. You have to have some ownership interest in the properties in order to claim material participation. So that is a really important test. Even though it's kind of buried in the criteria, material participation is a really important test to meet.
Now, we have a really great article on our blog, a primer on real estate professional status, and we'll definitely link that in the show notes for you to be able to refer to and read a little bit more. And it also talks about what are material participation hours, and it gives you actually some resources to be able to look at that. But I just really want to put all of this together for you because I know it was a lot of detail that we just went into, and kind of give you an example so it can make it a real life reality to all of you. So when Kenji and I first started out investing together in 2015, what we did was we said, okay, we're going to get real estate professional, and no, only one person in the marriage needs to get real estate professional status. So we said, okay, we're going to get real estate professional. We're going to make the goal of sheltering our income from taxes this year. And so what we did was we had Kenji cut back to half time, and then eventually he became a moonlighter as a physician. Why? Because we needed him to get more hours in real estate than he did as a doctor. So first he cut down to half time. And then we had to go out and buy enough properties that we could get over 750 hours in real estate. And we had to be able to get over 500 hours on our own portfolio. And so Kenji, was handling our properties. We ended up buying 12 units by the end of the year. And there's a lot of time that goes into buying units, doing due diligence, setting up your properties. And so he was able to get enough hours that he was spending more time in real estate than he was as a doctor with those units. And what was so cool is even though a lot of the units were very small properties, they were not expensive, they were fairly cheap at that time, we were still able to generate enough losses with depreciation. And then we also rehabbed some of our properties, which created additional losses, which we can talk about some other time. But it's basically like the government is paying for part of your rehab because you get tax benefits, because those are all considered losses on your property, even though they're increasing the value of your property. And so we were able to generate, between depreciation and rehabbing our properties, enough losses to be able to shelter both our clinical incomes from taxes. And that's how we were able to pay zero in federal income taxes that year. And we were able to do that going forward.
Now let's shift and talk about the second way that you can use real estate to shelter your income, and that is the short-term rental tax loophole. And this is a strategy that different than real estate professional status in that you don't have to meet that 50% test. 50% test is, again, where you have to do more hours in real estate than any other job. Here with the short-term rental tax loophole, you could be working full-time and still use real estate to shelter your income.
Now, I want to define what's a short-term rental versus a long-term rental, because a lot of people get confused here. They think that they start to think that real estate professional can be used for short-term rentals, but real estate professional is really about long-term rentals. So a long-term rental has an average length of stay of 8 days or more over the calendar year. So if you're getting a long-term renter who's staying for a year, that's obviously a long-term rental. If you have a midterm rental where you have traveling nurses staying for 30 or 60 days, that's still considered a long-term rental by the IRS. And in those cases, you're going to use real estate professional if you want to shelter W-2 or 1099 or business income using real estate. Now, the short-term rental tax loophole applies to short-term rentals. And these are rentals where you have the average length of stay over the calendar year of 7 days or less. And so if you are going to use this loophole, one of the things you really want to pay attention to is, what is my average length that my guests are staying over the calendar year? Because you don't want to buy a property and you're like, I'm going to use the short-term rental tax loophole. And then you get to the end of the year and you look and you've had some really long stays, and all of a sudden your average length of stay is 2 weeks. And you're actually considered a long-term rental, not a short-term rental. And so you just want to keep an eye out on this piece, because you want to make sure that you can use this short-term rental tax loophole if you're a full-time doc, or you and your spouse are both working and you're not going to be going for real estate professional status.
So what's the criteria for the short-term rental tax loophole? Well, the first thing is you need to have a short-term rental, right? So you need that 7 days or less on average across the year. And if you meet that, then you have a short-term rental. But the next key is you need to materially participate. And material participation we talked about earlier. There's 7 different tests, and you just have to meet one of them. Now, for long-term rentals, we talked about the 500-hour rule. But with short-term rentals, especially people buying their first short-term rental, a lot of people will use the 100 hours and more than anyone else. And what that means is you have to spend 100 hours working on your short-term rental, maybe setting it up, maybe just the buying process of the short-term rental, maybe managing it yourself. And then the other key is more than anyone else. So you have to do more hours than a property manager, a cleaner, a contractor, anybody who is working on your property, you have to do more hours than. And so what happens is a lot of people will be very careful about hiring property managers. They might not hire a property manager, or they might talk to their property manager and say, hey, I want to do a lot of the aspects of property management so that I meet the hours criteria. And then the other thing is that if you have a big renovation, a lot of people might push off that renovation to the next year so that the contractor doesn't do more than 100 hours or more than you. And so that's the criteria. Again, material participation along with a qualified short-term rental.
Now, Kenji's talking about material participation, and there are 7 different rules for material participation. He just covered one of them, which is the 100 hours and more than anyone else. And people in our community really use that when they're buying one short-term rental for the year. Now, people who own a portfolio of short-term rentals in our community oftentimes use a different rule of material participation. And so they'll group their short-term rentals together, like we were mentioning with Real Estate Professional, that there was a grouping option. They'll group their short-term rentals together and they'll do 500 hours plus across their short-term rental portfolio. And what that allows them to do is not have to do more than anyone else. And so they can have property managers. And we see this with people who usually have 3 or 4 short-term rentals. They have a lot going on and they say, well, I don't really want to self-manage. Let me group them all together. Let me go for my 500-hour rule this year, and then I'll call it a day. But there are other material participation rules that we're not necessarily going to cover, including one that's substantially all. So again, you need a really great CPA to talk you through your scenario. Ideally, you plan this stuff ahead with your CPA, and then you go out and purchase your properties once you have a clear plan in place, because you really want to understand all the different ways that you can get material participation and meet those rules and decide which one you want to go for ahead of time.
And just as an example, we bought a short-term rental for $660,000, and we bought it around September. And what we did was we set up the short-term rental. Before we were setting it up, actually, we fixed it up. We did a relatively light renovation on it. We didn't want to do an extensive one again because we didn't want the contractor to do more hours than us. And then what we did, then we rented it out towards the end of the year, maybe in December, about 3 times. Average stay was less than 7 days, and then we counted up all of our hours. One of the nice things about material participation is that both of us can participate. So I did a number of hours, Leite did a number of hours, and combined we did well over 100 hours. And then we looked at everybody else, and we did more than anybody else because we didn't have a property manager. We self-managed, and then we did have a cleaner, but they were only there once or twice. And then the other thing is a contractor. And the contractor, again, we did a relatively light renovation, so we did more hours than the contractor.
And what you can hear is we plan this all out ahead of time, right? Because we didn't blindly go in and do this giant renovation. We understood that we needed to get some stays before the end of the year, and we knew that we wanted to get material participation with 100 hours and more than anyone else. So we made sure that we didn't do a major renovation with our contractors, which made sense anyway because financially we didn't need to do a giant renovation. But again, if you plan this stuff ahead of time with your CPA, then you can make sure you don't fall into any mistakes that maybe don't allow you to be able to do that, take advantage of the loophole. Now, I want to clarify one more thing because a lot of times people get confused about real estate professional and the short-term rental tax loophole. And we already defined that real estate professional is for long-term rentals and short-term rentals is for the short-term rental tax loophole. Now, another one we get confusion on a lot of times is, like Kenji was just mentioning, we split the hours with our short-term rental tax loophole. And so even with real estate professional status, you can split the material participation hours between the spouses. But why this doesn't make as much sense is because somebody still needs to do the other 2 criteria, which is somebody still needs to have real estate being their primary profession. So they're doing over 50% of their working time in real estate. And that person still has to do over 750 hours. And so imagine you have a portfolio of 5 properties, and let's say Kenji and I own it. And Kenji does 300 hours of material participation and I do 200 hours. We're good for the 500 hours, but Kenji still has to do over 750 hours. So he still has to do those hours that I covered. He's still going to have to make them up. And so it doesn't make a whole lot of sense to split the hours when you're doing real estate professional status, at least in our experience. But with short-term rental tax loophole, it gives you that extra flexibility of being able to split those hours.
All right. Now, the third way doctors can shelter their income is with something called the medical practice tax loophole. And I don't know that anybody's actually named but
that's what we're calling it.
That's what we're calling it. And so what this is that when you're a physician, you have a medical practice, and let's say that you buy a medical office for your medical practice, and you house your medical practice in that office. Well, what you can do is you can group these two activities together. So you have your real estate, the medical office, and you have your medical practice, and let's say they're in separate LLCs, but then you group both of them together, and that allows you to take the depreciation and the losses from the building to offset your medical practice income. And what's really cool about this one is that you don't need real estate professional status.
Yeah. And so this one's so cool because you can imagine you buy a building, you're going to put your medical practice in it. You probably have some rehabbing to do. So you generate some losses there. And then you do depreciation and maybe you do bonus depreciation. You shift a lot of losses forward. And then you make bank your first year with your medical practice and you don't pay any taxes. And maybe you have some extra leftover tax losses that you don't use. They shift to the next year. And that year you don't pay any taxes at all either. That really helps you kind of get your practice going. It helps you to be able to get that check back from the IRS every year. It's going to help you be able to fund that rehab. I mean, it's so many uses of that money that comes back to you. And one of the cool things we've seen is sometimes primary care docs say, well, I'm just a primary care doc. I can't invest in real estate. I don't have enough funds. But what a beautiful thing to see primary care docs owning their own practice, creating medical office empires, buying other practices or practice offices and housing other doctors' offices in there and actually building their wealth that way. It's one of the coolest things to watch. And keep in mind, if you're a dentist or other professional, this works for you too.
So how does this work in practice? Well, I talked about forming separate LLCs. So one for the property and then one for the medical practice. Then the second thing you want to do is, again, you want to keep these two businesses separate, right? You want to think about these as two completely separate businesses. So then what you want to do is have the medical practice sign a lease agreement with the building LLC. And so the building LLC is the landlord, and then your medical practice is the renter, and you're renting the office space. And so you're paying rent to the medical office. Now let's look at the medical office. The medical office is getting rent, but it also has some expenses as well. So it might have, maybe it has utilities expenses, maybe it has mortgage interest, maybe it has property taxes. It probably has all these things, insurance. But then the other big key is that it has depreciation as well, right? Just like we talked about before, the building is going to be depreciated and you can treat that as an expense. And again, when you take the rental income that you got from the medical practice and you subtract out all those expenses plus the depreciation, generally you're going to have a loss. And that loss, again, can offset the medical practice income when you group those two activities together.
Now, that was a mouthful because he was talking about medical office and medical practice. Okay. So make sure that you really understand the difference. And really, what you need is you need to think about asset protection. So you need a good lawyer for asset protection because, like Kenji mentioned, you want to have separate businesses. And also, you need a really great CPA, right, who understands all of this, who's going to be able to help you think through the tax ramifications of all those things, like how much in rent should you pay? You got to think through all of these things. And so, a great lawyer and a great CPA are really necessities in doing this. And I really love the idea of not only doing this for your own medical practice, but building this medical practice empire where you buy other buildings and you have other practices and you're able to just create this empire that really what we've seen in our students who do this is it can get you to financial freedom much faster than you even expect, especially if you buy these practices really, really well. And again, it's lifetime income, right? It's income you'll be collecting 5, 10, 15, 20 years down the road. It's very, very cool.
Now, if you're looking for a great real estate CPA or asset protection lawyer, we can put our recommendations in the show notes below. So check that link out and then get an introduction from one of our preferred partners.
Yeah, we'll put some blog articles below on real estate professional status, the short-term rental tax loophole, and the medical office loophole as well, as we just covered a lot of detail, a lot of information. You might still be wondering, what is depreciation, right? We'll be able to give you some links for resources from Semi-Retired MD to be able to help you kind of dig into this. And then you'll be able to go kind of set out a plan and go harvest those tax savings. It's really amazing what not paying taxes, legally not paying taxes for years can do for the growth of your wealth. And we've seen it time and time again, not only with ourselves, but with members of our community. And so we would really love to see you take advantage of these and be able to create that generational wealth, the wealth that really changes your life, allows you to live a life you love, but also the futures of your children as well. Now, if you enjoyed this episode of the Doctors Building Wealth podcast, are all ready to go up and save some taxes, make sure you share this with other doctors and high income earners who, have practices or have office buildings, or maybe are interested in getting a vacation home or building a real estate portfolio. And so they can do it too, right? This is about sharing and really helping each other be able to grow these portfolios that create this source of income, so we can feel free to work on our terms in our day jobs. We'll see you next time.